Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Graham Corporation Quarterly Report. Graham Corporation offers a wide range of businesses and services across various industries. The company's product portfolio includes fluid, power, heat transfer, and vacuum technologies for chemical and petrochemical processing, defense, space, petroleum refining, cryogenic, and energy industries. The company provides several key products and services, including power plant systems, thermal management systems, heat transfer and vacuum systems, power generation systems, rocket propulsion systems, cooling systems, and life support systems. These systems are designed for various sectors such as the defense sector, energy sector, space industry, and chemical and petrochemical processing. In addition to its product offerings, Graham Corporation also provides spare parts sales and services for its equipment. The company operates globally, with a presence in the United States, Asia, Canada, the Middle East, South America, and internationally. With over 80 years of experience, Graham Corporation has established itself as a leading provider of specialized technologies and services to various industries worldwide. Graham Corporation's stock price skyrockets. A year of strong performance and strategic growth over the past year, Graham Corporation's, GHM, stock price has experienced a significant surge, with a 130.77% increase in 2024 and a further 45.51% rise in 2025. This remarkable growth can be attributed to several key news events that have contributed to the company's strong financial performance and strategic expansion. One major factor was the company's impressive Q3 FY26 financial results, which showed a 21% increase in revenue and a 50% rise in adjusted EBITDA to $6 million. The announcement also included raised guidance for the full year, further boosting investor confidence. This positive earnings report led to a significant stock price increase, with shares trading up 2.74% in pre-market on the day of the announcement. Graham Corporation's strategic acquisition of Flak Tech was another significant development that contributed to its stock price surge. The acquisition added advanced materials processing as a third core technology platform to Graham's portfolio, enhancing its competitive positioning and providing new growth opportunities. The company's record backlog of $515.6 million, marking a 34% year-over-year increase, also provided excellent revenue visibility and drove strong demand in the defense and space markets. This robust performance was further supported by a book-to-bill ratio of 1.3 times, indicating strong future growth potential. Overall, Graham Corporation's stock price has skyrocketed over the past year due to its strong financial performance, strategic growth, and record backlog. The company's ability to adapt to changing market conditions and expand its offerings through strategic acquisitions has positioned it for continued success in the years to come. Graham Corporation market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Graham Corporation trades at a higher price-to-earnings ratio of 62 times and a higher price-to-book ratio of 6.97 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the growth side, several factors contributed to the increase in revenue. Net sales rose from $114.1 million in 2024 to $123.9 million in 2025, driven by a 30% growth in the defense segment and a 13% growth in the energy and process segment. The U.S. geographic region also experienced a 22% growth in 2025. The acquisition of XDot Bearing Technologies contributed immaterially to fiscal 2026 revenue, while revenue from contracts recognized over time, including creation of assets with no alternative use to the company and enforceable right to payment, also played a role. Acquisitions such as FlakTech Manufacturing, LLC and FlakTech Sales, LLC, and increased sales to the defense industry further boosted growth. On the decline side, there are fewer explicitly stated drivers. However, the space segment experienced an 18% decline in 2025 compared to 2024. Aftermarket orders for energy and process and defense markets also decreased by 23% from prior year record levels, contributing to a total decrease of $5,151 to $7,963. The net income of the company has seen significant growth in recent quarters. In Q3 2025 compared to Q3 2024, net income increased by a substantial 79%, rising from $1,588 to $2,845. This trend continued throughout the year, with a year-to-date YTD increase of 35% from $7,835 in 2024 to $10,530 in 2025. However, despite this growth in net income, profit margins have experienced some fluctuations. The gross profit margin has seen a slight decline, decreasing by 0.8% and 0.6% in Q3 and YTD respectively. On the other hand, operating income margin has shown an improvement, increasing by 0.8% and 0.4% in Q3 and YTD. The reasons behind these changes are multifaceted. The primary driver of increased net income is a rise in sales, which partially offsets the decline in gross profit margins. Additionally, the impact of tariffs on the company's revenue has been estimated at $1,000 compared to the previous year. Furthermore, the absence of a grant received from the Blueforge Alliance has also contributed to the decrease in profit margins. Overall, while net income has seen significant growth, the fluctuations in profit margins highlight the complexities and challenges faced by the company in recent quarters. The company's financial performance indicates a stable trend in generating positive operating cash flow. According to the provided information, net cash provided by operating activities was $16,084 for both 2025 and the 9 months ended December 31, 2025. This consistent figure suggests that the company is successfully managing its operations to produce a steady stream of cash. Furthermore, an increase in cash and cash equivalents by $677 due to cash provided by operations also supports this notion. The fact that the company's operating activities are generating positive cash flow indicates a strong financial position, allowing it to meet its obligations and invest in future growth opportunities. Overall, these indicators suggest that the company is on a solid footing in terms of generating positive operating cash flow. The performance of various segments and regions in the industry has been mixed. On a positive note, the defense segment saw a significant increase of 30%, while the energy and process segment experienced a modest growth of 13%. In contrast, the space segment suffered a decline of 18%. Geographically, some regions performed better than others. The U.S. market showed an impressive growth of 21%, followed closely by Asia with a remarkable 51% increase. Canada also saw a moderate growth of 13%. However, the Middle East and South America lagged behind, with declines of 10% and 72%, respectively. A closer look at specific markets reveals some interesting trends. The defense market witnessed a substantial surge in orders, increasing by 43% compared to the prior year. This was accompanied by a significant increase in backlog, rising by 85%. On the other hand, the energy and process market experienced a decline in orders, decreasing by 20%, and a corresponding decrease in backlog of 9%. The space market showed some improvement, with orders increasing by 63% compared to the prior year. However, this growth was not reflected in the backlog, which only saw a modest increase of 6%. Overall, these results highlight the varying performance across different segments and regions within the industry. Management is optimistic about the company's outlook, citing several key areas of growth. The company plans to expand into new markets through strategic acquisitions, while continuing its momentum in new energy markets and small modular reactors. Additionally, strong tailwinds are expected in defense and space markets. The company aims to achieve a book-to-bill ratio of 1.1x, indicating a balance between sales and production capacity. Sales growth is anticipated in the aerospace market, driven by increased demand for industrial goods due to population growth and global middle-class expansion. To support long-term organic growth goals, the company will invest in production capacity and capital expenditures, which are expected to be 7–10% of sales per year for several years. Management is confident that these efforts will lead to higher net income and income per diluted share by fiscal 2026, as well as achieving its fiscal 2027 goals of 8–10% average annualized organic revenue growth and adjusted EBITDA margins in the low to mid-teens. The company's dividend policy is a notable aspect of its financial strategy. According to available information, the company has chosen not to pay out any dividends to its shareholders. This decision suggests that the company is prioritizing reinvestment in its operations and growth over distributing profits to investors. By retaining earnings, the company can continue to invest in new projects, expand its business, and potentially increase shareholder value through capital appreciation rather than dividend payments. There are valid concerns about inventory buildup or supply chain disruption. The data suggests that total aftermarket orders have decreased, while backlogs have increased by 34%, indicating potential issues with supply chain efficiency. Furthermore, there is evidence of high material receipts with lower profit margins, which could lead to inventory buildup and strain on resources. Additionally, the impact of tariffs on consolidated financial statements and delays in large capital project orders due to geopolitical uncertainty are also contributing factors. The situation is exacerbated by significant cost inflation in labor costs, raw materials, tariffs, and other supply chain costs. This is largely driven by increased demand for raw materials and resources caused by global supply chain disruptions. These factors collectively point to potential inventory buildup or supply chain disruption concerns. So that concludes the financial summary for Graham Corporation. Feel free to comment below, and I will be happy to answer them when possible.